Imagine this. You invested $100 every single month into Ethereum for 5 years. Rain or shine, bull or bear market, every 24th of the month you bought more ETF. No guessing, no timing, no panic, just pure consistency. How much would you have today? Now, what if you did the same with Bitcoin or the S&P 500, the benchmark for traditional investing? Today we compare all three. One strategy, 3 assets, 5 years of commitment. This is the power of dollar cost averaging. What is dollar cost averaging? Dollar cost averaging, or DCA, is one of the simplest and most effective investing strategies ever invented. Instead of investing a large lump sum all at once, which forces you to guess when the right time is, you spread your investment into smaller, regular amounts over time. In this case, you're investing $100 on the 24th of every month from October 2020 to October 2025. That's 60 months, or $6,000 total. The logic is simple. When prices are low, your $100 buys more. When prices are high, your $100 buys less. Over time, this averages out your cost basis. But beyond the math, there's something even more powerful happening. You're removing emotion from investing. No panic selling when markets crash. No FOMO buying when they spike. Just calm, automatic accumulation. That's why DCA is often called a behavioral advantage, not just a financial one. It forces consistency, and consistency is what compounds wealth. Ethereum's 5-year DCA journey. Let's start with Ethereum, the world's second largest cryptocurrency and the backbone of decentralized finance. In October 2020, ETH was trading around $200. Back then, the crypto market was recovering from a brutal bear market. Most people had already written Ethereum off as a bubble that burst. But you kept buying. Every 24th, $100, month after month. Fast forward to November 2021, Ethereum hits an all-time high of nearly $4,900. Your $100 buys a tiny fraction of an ETH at that point, but your earlier purchases, they've multiplied massively. By October 2025, Ethereum sits around $3,900, still below its peak, but far above where it started. Through all that chaos, the 2020 COVID crash, the DeFi boom, the NFT mania, the 2022 bear market, your DCA strategy stayed rock solid. Let's look at the numbers. Total invested, $6,000. Estimated ETH accumulated, around 5 ETH value today, at approximately $3,900 per ETH, about $25,000. That's more than 4 times your original investment. You didn't need to time the bottom. You didn't need insider knowledge. You just needed time and discipline. Now, why did Ethereum outperform Bitcoin during this period? Because while Bitcoin remained the store of value, Ethereum became the platform for innovation. Between 2020 and 2022, the explosion of DeFi protocols, NFTs, and smart contracts drove massive on-chain activity. Every transaction required gas, paid in ETH. This created real demand for Ethereum's native token. And as adoption grew, Ethereum wasn't just a speculative asset anymore. It became infrastructure, powering entire industries of decentralized applications. That kind of product-market fit fueled its rally. Bitcoin had the narrative dominance. Ethereum had utility. That's why Ethereum's DCA return was so impressive. Bitcoin's DCA performance. Now let's talk about the original, Bitcoin. In October 2020, Bitcoin traded at roughly $6,400. It had crashed over 70% from its previous highs. Headlines were calling it dead again. But the DCA investor doesn't care about headlines. They just keep buying. Month after month, your $100 accumulates more Satoshis, tiny fractions of a Bitcoin. Then came 2020, global uncertainty, stimulus money, and the narrative of Bitcoin as digital gold began to dominate. Institutions entered. MicroStrategy started stacking sats. PayPal integrated Bitcoin, and in November 2021, it reached $69,000. But as always, euphoria didn't last. The bear market of 2022 hit hard. Bitcoin crashed below $20,000, shaking out weak hands. Still, your DCA plan didn't blink. You kept buying, and those cheap months became some of your most profitable in hindsight. By October 2025, Bitcoin hovers around $111,000. Let's crunch the numbers. Total invested, $6,000. Estimated BTC accumulated, $0.5 BTC value today at $111,000 per BTC, about $20,000. That's a 3x return, slightly below Ethereum, but still remarkable. And again, you did it without stress. No FOMO, no panic, no sleepless nights trying to catch the next pump. Bitcoin's volatility would have terrified most investors. But for DCA investors, that volatility is a gift. Every crash means you get more Bitcoin for your money. And over time, the average cost basis smooths out those wild swings. It's also worth noting that Bitcoin's long-term trend has consistently rewarded patience. Every 4 years, its supply issuance halves, the famous halving cycle, historically leading to powerful bull markets. So while Ethereum captured the innovation premium, Bitcoin rewarded conviction. The S&P 500, the safe giant. Now let's look at the traditional benchmark, the S&P 500. In October 2020, the index traded around 2,700 points. The US economy was strong, tech was booming, and few saw what was coming. A global pandemic and economic shutdown just 18 months later. In March 2020, the S&P 500 crashed below 2,400, one of the fastest drops in modern history. But then, it roared back. The Federal Reserve unleashed record stimulus, and markets surged to new highs. By October 2025, the index cites near 6,800, driven by tech giants, AI growth, and a resilient U.S. economy. Using the same DCA strategy, $100 per month, your $6,000 would have grown to about $9,000. That's a 50% gain. Not explosive like crypto, but solid, and achieved with far less risk and volatility. Here's the beauty of the S&P 500 DCA strategy. You never risk total loss. You benefit from decades of compounding corporate profits. You sleep well at night. For investors who value stability over excitement, the S&P 500 remains the gold standard. The final comparison, Ethereum takes the crown, mainly because of its explosive growth between 2020 and 2022. Bitcoin trails slightly but still offers incredible compounding. The S&P 500, while boring, remains reliable and consistent. It's a perfect reflection of the risk-reward spectrum. High risk, high reward, crypto. Low risk, steady reward, stocks. Your outcome depends on what kind of investor you are. What the numbers don't show. Numbers tell part of the story. Psychology tells the rest. Because let's be honest, very few investors would have stuck with it through thick and thin. When the world was panicking in March 2020, would you have bought more ETH or BTC? When ETH dropped from $4,800 to $900 in 2022, would you have continued buying every month? When headlines screamed, "Crypto is dead," would you have had the courage to stay the course? That's the real beauty of DCA. It removes the hardest part of investing, decision-making during fear. You automate the process, you commit to consistency, and you let time work its magic. Even professional investors struggle with this. Timing the market perfectly is nearly impossible. But with DCA, you don't need to. In fact, studies have shown that time in the market beats timing the market almost every single time. Had you invested $6,000 lump sum in October 2021, right before the crash, you'd have lost money for years. But by spreading it out over 5 years, your risk averaged down and your returns smoothed out beautifully. What if you started today? Here's the most exciting part. This experiment doesn't just show past performance, it shows what's possible going forward. Imagine starting a DCA plan today in October 2025. Ethereum and Bitcoin are both strong, the S&P 500 is hitting new highs, and global markets are uncertain. It might feel like the worst time to invest, but that's exactly when DCA shines. You're not betting on next month's price. You're betting on the next 5 years, the next halving, the next tech cycle, the next wave of adoption. History shows that long-term consistency beats short-term brilliance. The best time to start was 5 years ago. The second best time? Today. Key takeaways. So what did we learn from this 5-year experiment? 1. DCA works, especially in volatile markets like crypto. By spreading out your entries, you reduce risk and emotion. 2. Crypto carries risk, but also massive upside. Ethereum and Bitcoin both turned $6,000 into tens of thousands, but they also required conviction to hold through extreme volatility. 3. Stocks are safer, but slower. The S&P 500 gave a steady 50% return, proving why traditional markets remain the foundation of many portfolios. 4. Time in the market beats timing the market. Perfect timing is luck. Consistent investing is strategy. 5. Behavioral discipline is underrated. The hardest months, the ones where everyone else panics, are often the most profitable in the long run. 6. Diversification is powerful. A mix of crypto and traditional assets can balance high potential returns with stability, the human side of investing. At its core, investing isn't just about numbers on a screen. It's about behavior, patience, and consistency. DCA teaches you to stay calm when everyone else loses their head. It rewards boring behavior. It turns volatility into opportunity. And it proves something simple yet profound. Wealth is built not by predicting the future, but by preparing for it. If you had committed to this 5-year plan, no matter the noise, no matter the market conditions, you'd be in profit across all 3 assets. The strategy didn't just make you money, it made you a better investor. So, are you Team ETH, Team BTC, or do you play it safe with the S&P? Let us know in the comments. Thanks for watching, and remember, stay patient, stay consistent, and keep stacking.